Welcome back to Financial Market Insights for Traders. I'm Sophia, and today I want to talk to you about something that quietly separates disciplined, consistently profitable traders from reactive, frustrated ones. It comes down to one core question. When you're navigating financial markets, should you trust macro signals or headlines? We live in an age of constant information. Your phone buzzes with market alerts. News apps flash breaking updates. Social media explodes every time the market moves 1%. The financial media thrives on urgency. Everything feels important. Everything feels immediate. But here's the truth. Not everything deserves your capital. The real debate isn't whether news matters. It's about macro signals versus news. It's about understanding what actually drives sustained market trends versus what simply drives short-term emotional reactions. So let's slow this down and unpack it properly. When I talk about macro signals, I'm talking about the big economic forces that shape markets over time. These are measurable data points. They include interest rate decisions and forward guidance from central banks. They include inflation data like CPI and PPI. They include employment numbers such as non-farm payrolls and jobless claims. They include GDP growth, bond yields, currency strength, credit spreads, and overall liquidity conditions in the financial system. These signals tell you what's happening beneath the surface. They tell you whether money is becoming more expensive or cheaper. They tell you whether liquidity is expanding or contracting. They tell you whether capital is likely to flow toward risk assets like equities or toward defensive assets like bonds and cash. Now compare that to headlines. Headlines are designed to grab your attention. They compress complex events into dramatic statements. Markets plunge on recession fears. Stocks soar after strong jobs report. Central bank shocks investors. Headlines are not necessarily inaccurate, but they are reactive. They describe what just happened. They are often written after the market has already moved. This is where the macro signals vs headlines distinction becomes powerful. Markets don't move long-term because of catchy phrases. They move because of liquidity. They move because of earnings expectations. They move because of interest rates, inflation trends, and credit availability. Let's talk about liquidity for a moment because it's one of the most underappreciated macro signals in trading. Liquidity is essentially the fuel of financial markets. When central banks lower interest rates and expand their balance sheets, liquidity increases. Money becomes cheaper to borrow. Risk appetite grows. Asset prices often rise. When central banks raise rates and tighten policy, liquidity shrinks. Borrowing becomes more expensive. Risk appetite declines. Asset prices face pressure. But what do headlines say during these shifts? They often attribute moves to investor anxiety or renewed optimism. That's surface-level storytelling. Underneath, the real driver is liquidity. If you understand liquidity cycles, you can anticipate major turning points before the media fully explains them. And this leads to another important point. Headlines are reactive. Macro signals are predictive. If inflation has been trending higher for several months, that's a macro signal. It increases the probability that central banks will tighten policy. Bond markets start adjusting. Equity valuations begin compressing. Currency markets respond. By the time you see a headline announcing a rate hike, professional traders have often positioned well in advance. Markets price expectations, not just events. Now let's talk about volatility, because this is where traders get caught. Headlines amplify volatility. Algorithms scan for keywords instantly. Retail traders react emotionally. Prices spike up or down within seconds. But here's the critical question you should always ask yourself. Does this move align with macro fundamentals? If it doesn't, there's a strong chance the volatility will fade. You've probably seen this before. A geopolitical headline triggers a sharp sell-off. Fear spreads quickly. Commentators predict cascading losses. And then, within days, markets stabilize because the underlying macro environment hasn't changed. This is the psychological trap of headlines. They trigger instinctive reactions. As humans, we are wired to respond to perceived threats. Financial media understands that. Fear and excitement drive engagement. But emotional trading is expensive. When you trade based solely on headlines, you tend to overtrade. You chase momentum late. You increase stress. You abandon structured strategies. Macro-based trading feels different. It's calmer. It's structured. It's built on probabilities instead of panic. Let me give you a practical example. Imagine inflation data comes in higher than expected. The headline screams that markets are rattled by an inflation shock. But when you dig deeper into the macro data, you might see that core inflation is stabilizing. Maybe energy prices drove the spike. Maybe wage growth isn't accelerating. Maybe bond yields had already priced in tighter policy. The macro signal might suggest consolidation rather than collapse. If you react to the headline alone, you might sell into weakness. If you understand the broader macro picture, you might stay patient and wait for confirmation. So how do you integrate macro signals into your trading process? First, you have to track leading indicators. Pay attention to purchasing managers' indexes. Watch the yield curve. Listen carefully to central bank commentary. Monitor credit spreads. These indicators often shift before economic slowdowns or expansions become obvious. Second, pay close attention to liquidity conditions. Are central banks expanding or shrinking their balance sheets? Are interest rates rising or falling? Is credit becoming more expensive? Liquidity conditions influence equities, bonds, commodities, and currencies in profound ways. Third, combine macro direction with technical structure. Macro signals can give you directional bias. Technical analysis can help with timing. If macro conditions suggest tightening, rallies may be selling opportunities rather than buying opportunities. Now, tools matter. If you want to focus on macro signals rather than getting pulled around by headlines, you need access to reliable data and structured analysis. The Crystal Ball Markets trading platform is designed to simplify complex macro analysis. It's a world-class, cutting-edge, user-friendly trading platform app that helps traders monitor economic trends and align trades with macro conditions instead of emotional noise. If you want to see how it works, you can explore it at crystalballmarkets.com/platform. Education is just as important as tools. Understanding macroeconomics takes time. If you want beginner-friendly insights into trading, investing, macro strategy, and financial markets, I highly recommend listening to the Crystal Ball Markets podcast series at rss.com/podcast/crystalballmarkets. The more you understand the forces behind market moves, the less you'll feel controlled by dramatic headlines. Now, let's be balanced for a moment. Headlines are not useless. They can alert you to sudden geopolitical events. They can highlight unexpected economic surprises. They can signal shifts in sentiment. But they should serve as alerts, not strategy. A disciplined framework looks like this. Use headlines to stay away. Validate the impact through macro data. Adjust your positioning only when macro conditions confirm the move. When you approach markets this way, the debate around macro signals versus news becomes much clearer. Headlines are short-term and emotional. Macro signals are structural and data-driven. Headlines describe events. Macro signals shape trends. Successful traders don't ignore headlines, but they don't allow headlines to control them either. So the next time markets swing sharply after a dramatic alert hits your screen, pause. Take a breath. Ask yourself whether you're seeing noise or a genuine macro shift. That one question can protect your capital and sharpen your edge. This is Sophia, and you've been listening to Financial Market Insights for Traders. Stay disciplined, stay curious, and always look beyond the headline.